I want to show you about a stock, TTEC. I'll just copy that. I'll paste that in Google and write stock besides it. And you can see the name here. And if I want to buy the stock right now, I have to pay $46.88 US dollars per stock, and the market cap is in billions, which means it's a big size firm. It has a dividend yield. The company that pay a dividend yield, it shows that they are financially very strong. The reason for that is that after paying their loans, creditors, and liabilities, costs, and everything, they still have money left, and that money they pay as dividends to shareholder, which means they are financially strong. So this is a good sign. And let's look. When was this founded? I'll just click here, Wikipedia, and you can see a box here on the right, and you can see founded 1982. I'll just go back now, and I will copy this, and I will just paste review and Indeed. I want to see what employees have to think about it. And it's 7,600 reviews, which is quite a lot of reviews to judge a firm. 3.5 star, it's above average, which is brilliant. You can read through the reviews yourself, then go to Glassdoor, and I'll just go to Glassdoor, and you can see the amount of reviews, and you can see 3.5 star, which is above average. It's brilliant. Now I want to go to Justia Patents. I want to see if it has any patents or not. And no, it doesn't have any patents, but I'll just try. I'll remove that part, click enter. No, I can't find any patents actually. Yes, so no, that's a different firm altogether. So no, it doesn't have any patents. Okay, if a firm has patent, that means they are very strong and they're very competitive. They are very strong in market. This firm doesn't have any patent, but there are many other factors that you can look at. I'll just go to Yahoo Finance and see their key executives, and I'll just click here and profile, and I can just see the sector and the industry and the full-time employees, and I can see that they have 5 key executives and all their salaries have been shown. The more the transparency, the better trust we are able to build. They have all their salaries shown, which is brilliant. Now I want to see macro trend, which is a brilliant website for ratios. Click price ratio, price book ratio, and type in here uh, the I'll just copy that, and I'll just paste in here. I hope that's the name, exact name. Yeah, and I'll just see the price book ratio. So if the price book ratio is less than 1, that means that the stock is undervalued, it's a discount, and it's cheap to buy. It's ideal time. If it's 1, that means that the stock is of real worth, and it's not overpriced. It's not expensive, which is brilliant. And if it's more than 1, that means that the stock is expensive. The higher the number goes, the more expensive it gets. So the stock is 5.91, which means it is nearly 6 times more expensive. Um, if I see in 2007 March, it's 6 times more expensive. If I just look up, I can see that somebody who buys that time will be paying $34 to buy something that's only $6 worth. So they're paying $34 to buy something that is only $6 worth. They're buying it 6 times more expensive. Right now, it's nearly 6 times more expensive. But the cheapest it was in 2008 December, when it was 1.39 times more expensive. So somebody who bought in 2008 December, they paid $7.86 to buy something that was $5.66. So it was cheapest that time, but right now it's 6 times more expensive. So you need to be careful about that. Let's go to other ratios. Let's look at current ratio. I'm looking at if the ratio is less than 1, that means the stock is risky. If the ratio is 1.5 or more, that means the stock is safe to buy, it's secure, it has margin of safety. Okay, right now it's more than 1.5, that means the stock is very safe. Let's look at the previous one as well. So it's always more than 1.5, it's very safe stock. Let's see that if it has ever been below 1.5. Yes, in 2006 June it's a little bit below than 1.5, but if you see that since we have the data, it's just once it has been below 1.5, but otherwise it's consistently above 1.5, so it is a very safe stock in terms of current ratio. Let's look at debt equity ratio. We are looking at zero point 0.5 or less than that. Okay, it's we're looking for zero point 0.5 or less than that, and it's more than zero point 0.5, it's a risky stock. And if I see the previous consistency, I want to see that. Yes, so I would say that since 2005 up till 2016 September, it's a very safe stock because it has always been less below zero point 0.5. But since 2016 up till now, it is a very risky stock. So recent 3 years, it has been a very risky stock because it's up more than zero point 0.5. So it's a risky stock in terms of debt. Let's go to return on equity. I'm looking for 8% or more than that. Okay, so I'm looking at 8% or more than that. It's more than 8%. In 2018, it's less than, it's in minus, which is not very bad. So I'm just looking at, so since 2005 up till 2017, it's more than 8%. It's brilliant. But then it just reduced completely in 2018, which is very bad. And then in 2018 December, it again became more than 8%. So I would just forgive this part maybe because it's not, it's just for 1 year. I would say the minus is for 1 year. But if I see the previous consistency, it's always been above 8%, and right now it's above 8%. So 1 year is fine for a firm to be bad. So you can just search why it was bad, or why, like why they didn't have a good income or whatever. So you can search on that further. So that's fine.